IPSAS 5, Borrowing Costs, provides guidance on the accounting treatment of borrowing costs incurred by public sector entities. Here are key points and principles outlined in IPSAS 5. 1. Scope and applicability. IPSAS 5 applies to borrowing costs incurred in connection with the acquisition, construction, or production of a qualifying asset. Qualifying assets are those that necessarily take a substantial period of time to get ready for their intended use or sale. 2. Capitalization of borrowing costs. Borrowing costs directly attributable to the acquisition, construction, or production of a qualifying asset should be capitalized as part of the cost of that asset. This includes interest on loans, borrowings, or other forms of financing used to fund the construction or acquisition of the asset. 3. Commencement of capitalization. Capitalization of borrowing costs should commence when expenditures for the asset are being incurred, borrowing costs are being incurred, and activities that are necessary to prepare the asset for its intended use or sale are in progress. 4. Cessation of capitalization. Capitalization of borrowing costs should cease when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete. 5. Calculation of borrowing costs. Borrowing costs eligible for capitalization should be determined using the actual rate of borrowing. When entities borrow funds specifically for the purpose of obtaining a qualifying asset, the actual borrowing rate should be used. Otherwise, a weighted average of the borrowing costs applicable to the entity's outstanding borrowings should be used. 6. Disclosure requirements. IPSAS 5 includes disclosure requirements related to the accounting policies for borrowing costs, the amount of borrowing costs capitalized during the period, and the capitalization rate used. 7. Treatment of surplus funds. If an entity has surplus funds invested in an interest-bearing account, the interest income earned on those surplus funds should be deducted from the borrowing costs eligible for capitalization. 8. Consistency with IPSAS. Entities are required to ensure that their accounting for borrowing costs is consistent with all applicable IPSAS. If a conflict arises between IPSAS 5 and another IPSAS, the requirements of IPSAS 5 prevail. IPSAS 5 aims to ensure that public sector entities appropriately account for borrowing costs associated with the acquisition, construction, or production of qualifying assets. By capitalizing these costs as part of the asset's carrying amount, entities provide transparency about the total cost incurred in preparing the asset for its intended use or sale. This enhances the relevance and reliability of financial statements.